welcome everybody to another webinar here with Route Consultant. For those of you who are here for the first time, my name is Josh Gregory. I'm the director of our consulting and training team here at Route Consultant. For everybody else, welcome back. And now, whether you're brand new here or you've been here a million times, we do want to make sure that this is still something both fun and educational. So this isn't going to just be a normal dry webinar. We're going to make sure that we have a little bit of fun. I'll talk about that in a little bit. Before I get started, I do have a disclaimer, the boring part that I do have to read first. So Route Consultant is not endorsed by and is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation, FedEx Ground, or Amazon. So all that means we're not going to be sharing any non-public information here, but we do want to share some things today that we think are going to be really valuable for a lot of you. And we will have a special guest who's going to come on a little bit later that I'll introduce in a little while. But before that, I just wanted to give a quick overview of all of the listings that have come out this week. I'm not going to go into all the specifics. You can go on the website and see the details or reach out to the team if any of those are interesting to you, and we'll make sure to give you all of that. So the first one is out of Northern Illinois. It is 6 P&D routes, $350,000 the asking price, 14% margin, has a manager, spare drivers, and it's a little bit higher mileage territory. The next three are actually all cars of the same overall business in Northern Georgia. So the first is 6 routes at $70,000. This has a manager, but no trucks. So you would need to bring your own trucks for this purchase. It's a rural operation, really cheap price point in the Georgia area. Next one is 6 routes at $81,000, 15% margin. Again, this one does not have trucks either, but it does have a manager as well. And then the third one is another set of 6 routes at $65,000, no trucks, about a 15% margin, and again, a really low entry point into the space. So 3 smaller pieces in the Georgia area that all would need to bring their own trucks for the deal. So those are the 4 new listings for the day. I also wanted to just quickly highlight, we do have 2 more events coming this month. So November 10th and 11th, we have a virtual summit. So for those of you who've never been to one or aren't familiar, if you're new to the space and trying to find out as much as you can about it, we've designed these summits as basically 2-day experiences where we will invest and spend as much time as we possibly can with you in 2 days to introduce you and educate you on everything around the FedEx space, really with the goal of helping you make the decision, is this the right industry for me to invest in? So the next one is November 10th and 11th, which is next week. And we have one more at the end of November. So November 28th and 29th. And again, both of those are virtual, so you can attend them from wherever. So if you have questions on that or want to join, we'll have links to that in the chat and on the website. Now, last thing before I introduce the special guest is just a reminder that at the end of this, we are going to have an open Q&A where you're going to be able to ask any question you want and have that answered by us and the guests. So the important reminder is, first, you have to put that question in the Q&A box at the bottom. If you put it in the chat, I'm going to miss it. We're not going to see it, so you won't get your question answered. So you got to put it in the Q&A. The other important thing is that for those of you who've been here before, you know that every week we will have a question of the week that we need you to answer before we answer your question. So the question this week is, what is the worst movie you have ever seen? And that's subjective. So whatever's worst for you. So when you're typing in your question, first answer that question, what your worst movie ever is, and then type in your question, we'll answer it and make sure to get to as many of those as we possibly can. But before that, I wanted to go ahead and bring on our guest for today. So Leland, if you want to go ahead and come online, and then we can go ahead and you can introduce everybody from there.
All right, great. Thank you, Josh. My name is Leland, and I am the CFO of Silicon Ledger. You may remember, possibly if you were here a few weeks ago, we were able to do basically an update on the employee retention tax credit, and there was a good bit of questions and things coming out of that from last time that we felt like there was an opportunity to come back and address this at a little bit deeper level. We certainly won't go too deep, but we want to make sure that we're providing as much information timely as possible, especially in light of last week's announcement from FedEx encouraging FedEx contractors to pursue the employee retention tax credit, at least consult and see if it's an option for them. And so obviously that's a space that we've been in with for quite some time now. We've worked with a lot of FedEx and Amazon contractors to be able to help them determine what their impact was. And so we want to just take an opportunity to kind of cover some of those items today with you. I've been in accounting for over 20 years. Silicon Ledger was formed to be able to help specifically initially FedEx contractors be able to navigate this process back in 2021. And we are in a unique position, we feel like, to be able to analyze the impact on FedEx contractors because of our basically decade of experience in this space and being able to understand the data and the financial impact that FedEx contractors have struggled with during this season, we'll call it. And as part of that, we partnered with Stout. And so I'll introduce those guys to you in just a minute. But ultimately, their entire background is in measuring impact based on certain scenarios. And obviously, this is one of those times where an impact was based on regulations and mandates, and they're in a unique position to be able to measure that as well, especially from an operational perspective. Silicon Ledger, as part of the platform, also is partnered with BDO. It's a top 8 CPA firm, so that we're working with, among the best CPA firms to be able to prepare and calculate the credit and make sure that we're doing this the right way and that the credit is maximized and be able to provide the best service possible. But overall, a turnkey solution. That's a key part here that Silicon Ledger is in a position to be able to provide in a unique way, especially for FedEx contractors. So we appreciate you being here today. Before I bring Jesse and Ray on, I do want to just kind of set the standard or set the expectation for our time here together today. The 3 things that I would like to see you come away with is, number 1, we want to share with you about the process and just help you understand that nobody can make this process completely pain-free, but we can make it pretty close to painless as possible. And just based on our experience and how many of these we've done. And we have the resources in place to be able to walk you through whatever questions and things that you might encounter as we're determining your eligibility and getting the tax returns filed for you. We want to be able to share with you, specifically, Ray will share with you some of the ways that FedEx contractors have been impacted during this season so that you can have an ability to relate to some of the things that we're seeing in a very broad, at this point, base of FedEx contractors. And then we want to share with you the basics of the program. We definitely don't want to go too deep into IRS regulations and rules. We don't expect you to remember or retain any of that. That's what we're here for. But we want to just help you understand the program at the appropriate level so that you can make a decision on how you might want to move forward. And of course, we'll do some Q&A at the end of this for anything that we might miss. So with that, I'd like to turn it over to Ray Roth. And I'll let him introduce himself there from Stout. Take it away, Ray. Excuse me.
Great. Thanks, Leland. I'm Ray Roth. I'm a director at Stout. I'm also a CPA. I'm also a certified fraud examiner. And as Leland mentioned, I've spent most of my nearly 20-year career doing impact analyses for various purposes. Most of that has been in the context of complex litigation. Laws and lawyers will always win or lose the day in court, but my role has been to say for how much. And so I quantify a causal event, usually the alleged action of the defendant, to put a number of what the effect of the plaintiff's business that had an impact on. And that's translated very well for ERCs because we have a very similar role in this process where we're quantifying the impact that government COVID orders had on your business, is that as a consideration for eligibility, including the time period that those impacts remained on your business. I've also worked with government regulators doing similar types of analyses, so have a flavor for how they think and look at some of these programs, which has been great experience for me. I work at Stout very closely with Jesse Morton, and I'll let him introduce himself.
Thanks, Ray, and thanks, Leland. My name is Jesse Morton. I'm a managing director in Stout's Atlanta office, and I am the Atlanta and Miami offices leader. I've been working on employee retention credits with Ray for over 13 months now, and I have worked with hundreds of clients on CARES Act related matters since the CARES Act was passed in April of 2020. So for over 2.5 years. And I've spent close to 20 years working with, for, and against the government in various contexts, but almost all related to fraud, waste, and abuse in government programs. And again, in various types of contexts. So with that, I want to give an overview of the Employee Retention Credit Program. Again, this is very high level, but the Employee Retention Tax Credit, or ERCs, it was established under the CARES Act at the onset of the pandemic, and it was designed to help provide economic stimulus to small businesses. And it really was rolled out along with the Paycheck Protection Program, but for a variety of reasons, the PPP was much more popular at the onset of the pandemic. ERCs have gained a lot of popularity due to changes in the laws, as well as people's recognition that they may be eligible for it. And what the ERCs do is it provides eligible businesses with a payroll tax credit that is received in the form of a paper check, a physical paper check from the IRS. And the credit has a value of up to $26,000 per employee. As Leland mentioned, there was an announcement by FedEx on the My Brown Biz website endorsing and encouraging FedEx contractors to look into and explore whether they may be eligible for ERCs. And that's pretty consistent with what we have seen on our side. While we have worked with a lot of FedEx contractors and Amazon contractors, what we found is that there are many FedEx contractors and other small businesses that either were not aware of the program or were given maybe not the most accurate or best advice, and therefore haven't had meaningful discussions with knowledgeable and experienced advisors in order to appropriately determine their potential eligibility for obtaining the credit. So to be potentially eligible, a business does have to have under 500 FTEs, full-time equivalent employees, and there are two ways to qualify. The first way is if a business had a significant reduction in revenue from 2019 to 2020 or 2021, or both. However, we recognize that this is not the case for the vast majority of FedEx contractors, given the increase in volume, the increase in demand, as well as increase in pricing to adjust for a lot of the issues. So the second way that a business can be potentially eligible for the credit is if a business was impacted either financially or non-financially by complying with government orders and or had significant supply chain related issues. And specifically what the IRS guidance states is that if a business had to make modifications to its operations in order to comply with COVID-related government orders, and the modifications had a more than 10% impact on operations, then the business can be eligible for the period of time that the orders were in place and the impact was greater than 10%. So on the next slide, what does this really mean? I mean, what I just said, I realize there's a lot to unpack there. So there are really three issues that I want to kind of dissect and get into in a bit more detail. So the first is what is a relevant government order? The first thing is there are no federal orders that are considered relevant for ERCs. OSHA and CDC, as well as other federal agencies, did put out some guidance, but based on the IRS notice that was released around employee retention credits, that is guidance only. They are not relevant for ERCs. So what does that mean? That means that government orders have to be issued by a state or local government. And the government orders that we've seen that relate to most businesses, and certainly FedEx contractors, are full and partial suspension of business operations. Again, I know that you all were essential businesses, so we're not talking about your business, we're talking about your customers' businesses or the locations that you delivered to and how that impacted you. Social distancing orders, restrictions on gatherings, school closures, as well as healthcare facility closures. So the second issue is modifications. So what modifications did we see contractors typically make in order to comply with those orders that I just discussed? And these broadly fall into, we've categorized them into 6 categories. The first are modifications that were made to the loading and unloading process at FedEx facilities. The second are modifications to the delivery process or for line haul to routes driven. The third are modifications to employee related matters. So recruiting, interviewing, hiring, training, and staffing. The fourth are modifications that had to be made to vehicle cleaning and sanitization. Next is supply chain related issues. So issues with obtaining vehicles, vehicle parts and service, as well as repair related issues. And then finally, the effect that all of these modifications had on your performance indicators and service rating dashboard. So what we're seeing, or the next issue is, how do we measure these impacts? How do we determine if the modifications actually had a more than 10% impact? And you'll see on this slide, we give a high level overview of some things that we are seeing in terms of how those modifications impacted your operations. So we're seeing increased times to load and unload delivery vehicles, increased times to complete routes, time spent cleaning and sanitizing vehicles. And sorry, I did want to go back to the completion of delivery routes, because what we're also seeing is that, especially for those contractors that had a high number of deliveries to non-residential locations, those tended to be the ones that had the highest impacts. The supply chain related modifications, again, the inability to find vehicles and parts, increased repair times, as well as the cost impact to get repairs completed. And then on the employee related issues, higher turnover rates, higher number of absences, increased training time, and the lack of training resulting in errors, accidents, and injuries. So with that, I'm going to turn it over to Ray, who's going to go over some of the specific amounts and impacts that we have seen from the hundreds of FedEx contractors that we've worked with. Ray?
Thanks, Jesse. So as I started with, I really enjoy doing data and other types of financial analysis. And we were in a pretty unique spot here where we've worked with hundreds, approaching 1,000 or maybe even exceeding 1,000 delivery contractors. And so we had all this data related to how you were impacted by the pandemic, specifically the government orders that Jesse mentioned and how that relates to ERC. So our magic threshold that we're trying to get over is 10% or more impact, because that's what's prescribed by the IRS. And so the slide we're looking at here is the distribution of our analyses. So the y-axis on the left here, this is the percentage of respondents that answered within how we bucketed their impacts. So in this chart we're looking at here, over 48% of respondents had a between a 10% or 20% increase on the time to load and or unload their vehicles at the start and the end of and at the end of the day. And this waterfalls out to higher impacts, but over 90% of the contractors we've worked had more than a 10% impact, with 40% of our contractors having more than a 20% increase. And this was important to us because we see it's very consistent. It's not just one contractor having an outlier type issue. The outliers are actually on the other end, those that had a less than nominal impact. The reason we're sticking on loading and unloading, so we look at the qualitative factors, which are the modifications made or the things that have changed because of government orders that drove that 10% or more impact. And a lot of the issues with the loading and unloading, as I'm sure you are probably all aware, are issues that are commonly with FedEx and their package handlers. Almost 98% indicated that it felt like the package handlers were not adequately trained or experienced. More than 1/3 of respondents indicated that FedEx was actually trying to poach your drivers into package handler roles. I actually suspect this percentage is higher. This is the known poaching or attempted poaching. There's probably more going on than what came to the surface. Most responded that vehicles were loaded improperly. That include scanning issues, loaded but not scanned, and scanned but not loaded errors. Most responded that this increased your driver frustration. Most of you have told us that a lot of your drivers, after they left the FedEx facility, were parked at a gas station or some parking lot, had to take everything out of the vehicle and then reorganize it so they could get through their route efficiently. The whole time hoping they don't get robbed with all these packages outside their vehicle and sitting in an inopportune spot. Moving on to getting on routes and in the delivery process, pretty same or similar distribution here. A little more than half fall in the 10 to 20%, and collectively over 85% have more than nominal impact. I think I got ahead of myself. So this is delivery, similar percentages. Unpacking the delivery, no pun intended there. the reason for the delivery increases, mail rooms and central delivery locations were commonly closed. So drivers typically had to go door to door at apartment complexes, condos, office buildings, instead of just deliver to the one central location. If that wasn't bad enough, because of social distancing, only 2 people could be allowed on an elevator at one time. So that often created lines and waits just to get from floor to floor. And that's assuming you were even able to get access to the building to begin with. Those types of buildings, you commonly had trouble getting buzzed in. Other schools, with those being closed, didn't mean the subscription deliveries stopped, but you had packages that you couldn't get in. Same thing with nursing homes, because of the visitation rules and orders around those, common entry issues, being able to find packages on your pickup attempts. We've been told was challenging because you had different people, new people, not knowing where to find it. And then probably an overlooked item, if you weren't in this industry, was just being able to take a restroom break while you were out on your route.
And a lot of these, Ray, if you can go back, a lot of these go back to the comment that I made about how we are typically seeing that those contractors that had a high percentage of deliveries to non-residential or not single family residential tend to have the best cases. That's not to say that we have not been able to find more than nominal impacts or more than 10% impact for delivery drivers that have a high percentage of single family residential deliveries. It just tends to be harder to get there because, again, when we're trying to make a causal connection between the impacts and the government orders, when you think about the process of delivering packages to single family homes, there just wasn't that much of an effect. Now, that being said, when we've talked to contractors who are in places like Florida and Arizona, where there's a lot of retirement communities, and they had to wait at gates in order to get into these communities, we are seeing those impacts. So again, it's worth at least having the conversation if you do have a high percentage of single family residential deliveries, but think about, you know, a lot of these reasons, and I'll say, if it doesn't sound like you have a lot of these reasons, don't get your hopes up too high, but it's still worth having the conversation.
Moving on to labor and supply chain impacts, we see pretty consistently a lot of you were unable to cover the same amount of routes that you were prior to the pandemic, because I think for a couple of reasons. First of all, your vehicles, being able to buy new vehicles, repair vehicles, was significantly impacted by part supply shortages. I think it's fairly obvious at this point that automotive supply chain was severely disrupted throughout the pandemic. There's a lot of reasons that go back to orders, including domestic manufacturer shutdowns, issues at ports, bringing in foreign parts and components, and then getting those materials onto trucks to leave the ports. But if you don't have trucks, or if your truck is down for significant periods of time, you're obviously not going to be able to cover the same percent of capacity. But it also feeds into the delivery issues that we spoke about. If it takes 20+% longer to complete a route, what used to be able to be completed in one person in one truck, you may now need 2 people and 2 trucks. And that's what we're seeing here, where more trucks were needed to cover the same route capacity. And here the bar that's jumping out is the 20 to 30% additional vehicles needed. And needing 20% or more employees to cover the same routes. And here we're looking at increased time on recruiting and hiring on the left. Probably no surprise of the additional time needed here. And then similarly with training, once you got people in the door, ride-alongs were generally not allowed for having more than one person in the vehicle to comply with social distancing, as well as other group meetings at the start of the day, and being able to communicate critical safety information, and or best practices as you got going at the start. So those are some of our high level metrics. I'm going to now turn it back over to Leland.
And sorry, I want to jump in and make one quick point. Sorry, Leland. As we're going through these, Ray just went through a lot of information, and it's pretty clear that pretty consistently we are seeing a lot of areas where the impacts are greater than 10%. I did want to clarify, though, that what we're looking for is an overall more than nominal impact, or 10% impact. So if delivery has 0 impact and loading unloading has 0 impact and recruiting has 20, you're not going to get there. What we're seeing is that pretty consistently throughout the pandemic, across the board, there were more than nominal impacts to all of these areas. And then you kind of stack them up on top of each other. And that's how we're making our case that there was overall more than a 10% impact on operations. By far, the biggest thing that we look at, though, is, hopefully not surprisingly, the delivery process. That is the vast majority of the time and effort and energy and cost that goes into your day. So that is the primary thing that we look at. The rest of these areas certainly help, but we definitely rely most on the impacts to the delivery process.
Okay, great. All right, thank you, Ray. Thank you, Jesse. So we're going to pause here and just talk about a couple of different things, and then we will knock off the third item that we wanted to cover, which is the overall process. So I'm going to take this opportunity to talk a little bit about what Spencer had talked about at the Expo back in August. So at the Expo, Spencer had made available the opportunity for a referral program. That referral program was actually it sunsetted in early October. And so for those of you that are on this webinar, maybe you've done this, maybe you're questioning it, maybe you need some more information to be able to move forward. But ultimately, if you're on this webinar, we are opening that opportunity back up to have an opportunity for a referral fee associated with people that you bring to Silicon Ledger to have an opportunity to determine impact. And ultimately what that looks like is, any of these things that Jesse's about to go over as far as other opportunities. It can be FedEx, it can be something other than FedEx. So it's a way for you, as Spencer had mentioned back at the Expo, beyond you getting the benefit of a credit for your company, it's another way for you to benefit from this program during this difficult season. I think even FedEx right now acknowledges that this is a difficult season for FedEx contractors, and there's any number of reasons for that in the market. And so I don't think that's a surprise to anyone, but every opportunity to benefit and try to create new revenue streams, as Spencer mentioned at the Expo, is something that he and I think we all would encourage you to take advantage of. So if you have a referral for us, we're happy to talk to them, even if they're not on this list that Jesse's about to go over, and even if they're not a FedEx contractor, there is a new opportunity for you to get a referral fee related to this program. Should the group or the company that you refer to us be eligible for the credit. And essentially that rewards you for having given us the opportunity to work with them. And hopefully as well, if you're here and we've worked with you, great. There's some other opportunities we can work with you here. And if you haven't yet, we're happy to have that call to continue to move things forward. So with that, Ray, I'll turn it over to you to discuss the different industries.
I'll cover them.
With Jesse. Okay. Sorry, Jesse.
No worries. So these are some of the industries that we have worked with, and the industries that we have worked with also tie in to one of the questions that was asked, which we will address in more detail shortly. But these industries that we've worked with, we consider to be lower risk industries. And the reason why we consider them to be lower risk industries, meaning they are industries that have the most obvious impacts and had to make the most obvious modifications to their operations, and in some cases were specifically cited in IRS guidance as examples of what would qualify or likely qualify for employee retention credits. But these are all industries that have been either identified in GAO, Government Accountability Office reports, or Treasury Inspector General for Tax Administration reports, or otherwise have been recognized in different pieces of legislation as being the businesses that were most impacted by the pandemic. So we intentionally work with businesses and industries that we believe have the highest probability of getting of having successful ERC claims, and if they are challenged by the IRS, would survive a challenge because again their modifications and impacts were obvious. So a couple I wanted to highlight are, again, auto collision service, parts and repair, auto parts and components manufacturers. The entire auto supply chain was well documented, was just devastated. And that includes auto dealers as well. Construction, including home builders and specialty contractors such as electricians, plumbers, HVAC, painters. Again, thinking about going into people's houses, as well as supply chain related issues, employee related issues, also home design and interior improvement. Gyms, again, probably perhaps even the most obvious one. I know my gym was closed for months at a time, and even when they opened, there was significant spacing and capacity restrictions. We're seeing a ton of impacts with dental and dental related practices, home care and healthcare related companies, hotels, restaurants. Those come straight from the IRS guidance as examples that were given, as well as, I'm going to jump to the last one here, but daycare, childcare, preschools and private schools. Again, pretty obvious given the fact that they were closed early on. When they opened for online only. When they opened for in-person, a lot of times they were staggering who could go to school, all sorts of kind of obvious modifications. So, if you're looking for referrals, or maybe if you own other businesses in these industries, certainly worth reaching out. But to Leland's point, this is not a full list. So I would recommend reaching out and seeing whether, if you've got a business that may be interested that's not on this list, it's worth having a discussion, because this list certainly isn't exhaustive.
All right. Great. Thank you, Jesse. So just to kind of rehash what our goals were here, and I think what we've covered, we've got, talking about the FedEx contractors, how they were impacted. Ray was able to cover that in a level of detail to be able to pull from actual data, actual contractors just like you, and hopefully some ways that you were able to relate. Jesse's been able to cover just kind of the high level basics of the program, what makes you eligible, what may not make you keep you from being eligible, and just some of the high level view there. So the last step here for us to be able to cover is just, what does the process look like? So ultimately, if you're interested in finding out more here, there's an email address and phone number here at the top of your screen, and you can engage through either one of those avenues that you see fit, whichever one works best for you. Ultimately, once you reach out, someone from our team will be assigned to you so that you have a project manager that you can talk to. And throughout the process, you've got one place to go for any questions that you might have, documents that you might need to submit, or whatever correspondence might need to be provided. And it doesn't have to be, this web of I need somebody to talk to, but I'm not sure who. You have a relationship with somebody on our team. We've invested heavily in that side of things to be able to make sure that the process is as painless as it can be for you. And so that agreement is just essentially the terms of the agreement for us to be able to perform the services. And those services are collecting data, doing an impact analysis, which Stout, as they've disclosed here, are significantly involved with. Once an impact is defined, then BDO, that's when BDO becomes involved. That's the CPA firm. That's when a credit is actually calculated. Plenty of people will start asking us early in the process, well, how much am I eligible for? And it's just too early to say early in the process, because we don't even know, without the impact analysis being done, what quarters to even calculate a credit on. But once the impact is determined, and we know which quarters that you're eligible to claim the credit for, that's when the credit can be calculated and the tax returns can be prepared. So it's a turnkey solution that allows you to be able to provide information, answer questions, and we, having done a lot of these at this point, can, on the background, take care of this for you and provide this, where all you have to do is sign the tax return, submit it to the IRS, and the process is complete at that point. So that questionnaire is listed here on number 4. Once you complete the questionnaire, upload the documentation. Stout provides the analysis within 5 to 10 business days. This doesn't have to take a long time to know whether you're even eligible, because that's going to be the first question. Am I eligible? Then how much? Once we know that, we coordinate with the tax group at BDO to be able to do the credit and the preparation. And once those tax returns, as I mentioned, once you sign the tax returns and submit them, we see some small businesses receive their credits in as little as 3 months. I mean, this doesn't have to be as long of a process as it initially was. The IRS was, and to some degree still is, overwhelmed by the process. So I don't want to make it look better than it really is. I mean, it could take the 6 to 10 months, but what I can also say is that we're seeing people consistently get them in less than 6 months and as early as 3 months. So in some ways, the process has been improved over the last, I'd say, 6 months. And as you can see here at the bottom, typically your total level of effort for the entire process is 5 to 10 hours. We certainly want to make that, the 5-hour type level, but everybody's facts and circumstances are different depending on what state you're in, what type of FedEx operation you have, meaning line haul or pickup and delivery. And then, just so many factors that can come down to what type of territory you're serving. So we need to spend enough time on your business to make sure that you individually have got a reasonable cause to be able to claim the impact. So that's the overall process as far as from beginning to end. That includes who's involved, and then kind of an expectation, a level of, how long does it take for the IRS to be able to provide the funds, which is what you're really pursuing here, to be able to get some relief during this season. So with that, I think we're done here. So I think we can move to Q&A, and Josh, I will open it up to you on that front.
Perfect. All right. Yeah. And a reminder for everybody, as you're typing in your question, make sure you answer our question of the day, which is, what is the worst movie you've ever seen? So while we're giving everybody a chance to type in their questions, why don't we do a quick round robin of what everybody's worst movie is from our team? So I'll go first. Worst movie is a movie called The Counselor. It's not the worst movie I've ever seen, but it's the worst, and it will live in my memory for all time because it's easily one of the worst first date movies I've ever been to. I went with my now wife, so thankfully it worked out, but we frequently talk about how it was just one of the most horribly awkward movies to go to on a first date.
All right. I'm going to Google that one here real quick. I would say for me, Geely is the worst one, and it's the only one I've ever walked out of a movie theater for and just walked away from my money. So that took a lot. And so if you haven't seen it, don't. It's old and it's not worth your time.
Perfect.
I'll go next. I'm going to say the English Patient. That was a movie that was in the movie theaters when I was like a teen or tween. My grandmother had taken me to it. Could have picked anything I wanted, and I heard it won all these Academy Awards or something. And that's when I learned that just because a movie wins an Academy Award does not mean it's a good movie.
Very true. I
would go the opposite and say if it wins an Academy Award, it's probably not a good movie. When you said that, it reminded me of another bad one, but I was going to go with Howard the Duck.
Oh yeah. How about that movie?
Yeah, throwback from the 80s. But Ray, when you were talking about the Academy Awards, I was thinking of Lost in Translation, which I was wondering when the movie was going to start, when the credits started rolling in the end.
That's good.
Oh, man. Okay, so let's get over to the Q&A now. So I've seen a couple of people and we touched on it briefly, but is there any context or any kind of additional description you can give on what it might look like? Let's say if they are audited, or any alleviation you can offer in that they won't be audited. Anything else you can provide there? Few people kind of asking about that likelihood.
Sure. Common question. Great. So number one, if you receive any kind of notice from the IRS regarding your amended tax returns, we want to be the first person that you reach out to here at Silicon Ledger. That is part of the role, part of the service that we provide. And keep in mind, I think there's a tendency with small businesses, when they're dealing with the IRS, they're immediately going to just think about the worst case scenario, which is that audit word. There are other steps that, it could just be some sort of request for additional information. It could be clarification about the tax return. There are other reasons that you would receive IRS correspondence that would still need a response that we can provide on your behalf. But, I don't want people to just think, gosh, if I see an IRS notice, I must be getting audited, because that's just not the case. So ultimately, we want to be your first call. We will work with you to get a response in place and sent back to the IRS, regardless of what it is, because keep in mind, you're turning in amended tax returns. The full report, everything that you receive to support the impact is not going to the IRS. So it's not out of the realm of possibility that they just say, hey, look, can you send us what you base this on? And it would be simply submitting the report. That's part of why you are engaging someone like us, is to be able to have that documentation to be able to justify the credit. There will be plenty of people that don't take that step. And so you're already in a better camp to be able to stand firm in front of the IRS on this. If there's a need to, like, let's say they question maybe an owner wage being calculated or not being calculated, something like that. I'm just giving a specific instance. We would probably talk to BDO and make sure they review their calculation. We would review the calculation, and we can engage the accountants to help with that response at our cost if needed. But that would just be on kind of an as needed basis. But we want to be the first. We want to be your first call. We want to have the opportunity to help craft that response to the IRS so that that's not on you. And just keep in mind that just because you hear from the IRS does not mean you're getting audited. It just very easily could be they have one simple question that they need clarification on. We've seen that, and it doesn't have to be a massive lift for you.
I think, you go.
Oh, sorry. I could talk about this for like an hour alone, but I will try to be as succinct as possible. So, I'm trying to address a couple of the questions that were asked. So yes, the IRS did extend the review and audit period to 10 years from the standard 7 years. And they did that because, and I'm sure most people on here have heard the radio ads, have seen the ads on CNBC, have seen pretty grandiose promises from what I will call the ERC mills, and probably a lot of you have seen the IRS letter that came out. I think it was 2 weeks ago, warning businesses about ERC mills. This is an area where there is a massive amount of fraud, waste, and abuse. There's fraud, waste, and abuse from, I'll say taxpayers, but non-taxpayers. There's fraud, waste, and abuse by business owners. There's fraud, waste, and abuse by ERC mills, and we're seeing that. So I fully expect that there will be a lot of scrutiny around employee retention credits, and that is why they extended the period to 10 years. Now, that being said, much like the PPP program, you had a lot of bad actors, but you also had a lot of people who did the right thing and followed the process and got good advice and went through the evaluation process, got an evaluation about the claim, did everything right, and they are not getting scrutinized. So I think there's a couple key takeaways here. One, overall big picture, yes, ERCs I fully expect to get scrutinized heavily by the IRS, but I think that there are going to be clear red flags of types of businesses and industries that are filing, the substance of the claims that are being filed in terms of the periods that are being filed that will raise red flags, the companies that prepared the documentation, and whether they are from these ERC mills. And I further think that a lot of people that do get challenged will not have the right documentation and support to substantiate their claim. That's why we go through a very extensive process. I mean, I don't know how many of you have seen our analysis, but our analysis is 30 pages long, sometimes, more. The Silicon Ledger provides everyone a full file with the calculations, our analysis, everything that's needed if the IRS does ask questions. And we're very confident that if the IRS does ask questions from some of you, that it would survive a challenge. Now, that being said, in an absolute worst case scenario, even if there is an audit and the IRS happens to disagree, you're not talking about criminal charges here. Assuming that the documentation you provided us and Silicon Ledger and everyone else is accurate, the worst case scenario is they disagree in your good faith claim and you have to pay back the ERCs. So the advice that I give everyone, I think Leland agrees with me here, is when you get your check, don't do something stupid with it. Invest in the business, invest, put it away, see how things shake out for a little while, and then go on from there. The people that we're seeing in PPP and Paycheck Protection Program that are getting indicted, that are getting scrutinized by, in this case, Department of Justice, SBA, and others, are ones who flat out abused the program and just flat out committed fraud. So yes, I think there's going to be a lot of scrutiny, but because of the risk mitigation that we and Silicon Ledger are going through, we think we're putting our clients in a very good position to succeed a challenge. And as I've said many times, Stout's been in business for 31 going on 32 years, and we plan on being in business another 32 years. We do a lot of work for and against the government. We've got a really good reputation, and there's a reason that we're in this space and doing all the right things.
Yeah, I think that's the whole reason that, that's kind of the clarification, but also the reason why you work with someone like Stout. It's like, we're providing documentation to help, but also there when you need questions on the back end, if it comes to that. So hopefully that answers a lot of those questions around the audit and the IRS. A couple of quick ones that did come in, because we're running short on time, so I wanted to try to get to these. So Dell, Barbarella was the movie, which classic. So some of these are fringing into the so bad they're good territory. Question was, do I have to refile returns for years that I qualified for the credit for previous years?
Okay. So let me make sure that I understand the question. When he says refile returns, I'm assuming he means that he's got to amend his corporate tax returns. Like, let's say he's an S Corp, then I'm going to make the assumption here that he's filed an 1120S for 2020 and 2021. And I think what he means by that is the fact that he receives this credit related to those tax years. Does he have to go back and amend those corporate tax returns? And the answer is yes. So if you receive any portion of your credit on a 941X for 2020, you've got to go back and amend your 2020 corporate tax return. And just the same, if you receive a credit for any part of 2021 related to an amended 941X, you do have to go back and amend your 2021 corporate tax return.
Perfect. And Dell, if there's any other follow-up you have there, just reach out to the team. We'll help there. Next one is from Garrett. Kung Pao Enter the Fist. So bad it was hilarious. I love that movie, unabashedly. So it's one of those, again, so bad it's good. Regarding personal metrics, do you give anything that shows kind of where they stack up versus peers and how they are how far they are over the 10% threshold? What kind of data do you give to people going through the process in terms of kind of how far they qualify?
That's a good question. And Ray and Jesse may want to step in here and provide additional, but ultimately the report that you receive to support the impact on your specific business is specific to your business. The report does address impact to the industry that you're in, because we're trying to create context and in many ways educate an IRS agent or whoever might be reviewing it. Because keep in mind that they might have just reviewed a gas station and now they're looking at a FedEx operation. And if they don't have context for what industry it is and how it may have been impacted, there's just a level of education that we try to provide related to the industries first in the report and then specific to your business. When it comes into the relation to the other metrics, I'll let Jesse or Ray maybe want to add some context there. Being able to measure it and see how you stack up in the pool has been very helpful, but I'll let Jesse and Ray maybe take over that additional part there.
Ray, since you're the analytics guy.
Yeah, I wasn't sure if you wanted to take that. Yeah, so Leland's absolutely right. Your analysis is going to focus on you. We do have an industry background section in our report where we will provide some high level information on the industry, that it's not just you, the industry as a whole was affected. That's more qualitative. But the guidance that the IRS has issued, some of its follow-up guidance that the AICPA has issued, is this should focus on you. And so that is where our analysis is going to conclude, and we're not going to add noise of this is how everyone else is, but it'll be your numbers.
Perfect. All right. Well, that is all we have time for today. We are right up at the end of it. So thanks everybody for coming out this week. Thanks everybody, Ray, Jesse, Leland, for joining today. And we'll let you guys go. Have a good rest of the week. Don't forget, We have an investor summit coming up next week, the 10th and 11th, and one at the end of November, the 28th and 29th. If you're looking for one of those are two of the last of the year. So if you have questions on that, reach out to the team. And then if you, I believe Danielle put in the chat as a reminder, a couple of links for going to Silicon Ledger to ask more questions, to find out about how to apply if you missed any of it or just are trying to reach out. So go there and we will let you guys go. See you all next week. Thanks, everybody.